Ladies and gentlemen, good day and welcome to the Punjab Chemicals and Crop Protection Limited Q2 and H1 FY2026 post-results conference call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Riju Dalui from Antique Stock Broking. Thank you and over to you, sir.
Thank you, Sarthak. On behalf of Antique Stock Broking, I would like to welcome all the participants on the call of Punjab Chemical and Crop Protection. From the management side, we have Mr. Salil Shroff, Managing Director, Mr. Vinod Gupta, CEO on the call. Without further delay, I would like to hand over the call to Mr. Gupta for his opening remark, post which we will open the floor for Q&A. Thank you and over to you, sir.
Thanks. So good afternoon, everyone, and thank you for joining the call today. It is my pleasure to extend a warm welcome to all the participants in this Q2 and H1 FY26 earnings conference call. We sincerely value your time and continued interest in our company's performance. I trust you have reviewed the financial results and investor presentation, which is now available on the stock exchange. In call with me today, we have Mr. Salil Shroff, our Managing Director, and Mr. Vishan Singh, who is our Finance Head. In our industry, so overall, first I'll begin with the industrial scenario. The overall industry continues to show signs of recovery after a prolonged period of correction. Inventory levels across the key markets are normalizing and pricing trends have begun to stabilize, supported by gradual pickup in demand across each user segment. The global chemical industry has also witnessed improvement during the quarter, aided by easing supply chain pressure, stable raw material cost, and revival in industrial consumption. I am pleased to share that Punjab Chemical delivered a steady and positive performance this quarter. Revenue from operations stood at rupees 255.2 crores, reflecting a 5.4% year-on-year growth. This performance was driven by consistent momentum across both domestic and export markets. Gross margin stood at 39.5% and EBITDA at 26.2 crores, representing 2.5% year-on-year growth. We had, as all of you are aware, that Punjab was hit by heavy floods during the last quarter, and our EBITDA margin took a hit of about 1% due to sudden jump in fuel prices as the fuel became scarce and supply was short. Our focus on operational excellence, product quality, and cost management continues to strengthen our competitiveness in an environment where supply capacities remain elevated. During the quarter, we continue to reinforce customer relationships, enhance research and development initiatives, and invest in technical capabilities to support long-term growth. We are in advanced stages of developing several new molecules across both agro, performance chemicals, and specialty segments, which are expected to be commercialized over the next few quarters. The new molecules introduced over the last few quarters are gaining strong traction, both in domestic and international markets. Their contribution to overall revenue is steadily increasing, and we expect their value addition to strengthen further in coming quarters. The CapEx plant announced last quarter to build new manufacturing block is progressing well. This investment will cater to our rising demand of existing products and support new product pipeline and also enable faster commercialization of upcoming molecules when operations commence. At the same time, we continue to invest in asset renewal. So our asset renewal exercise continues on a regular basis. Last quarter, we had taken up a revamp of one production block, and in this quarter, we have taken up revamp of 2 more production blocks. Additionally, we are evaluating a new site to support our medium to long-term growth trajectory. This will further diversify our manufacturing base, enhance supply resilience, and provide scale benefit as we ramp up production of new products. Our business development team continue to pursue new opportunities through deeper customer engagement and strategic collaborations. The company remains committed to advancing innovation and expanding its chemistry portfolio and capturing value in niche high-growth segment of specialty chemical. We remain confident in our strategic direction and continue to focus on delivering sustainable value to all our stakeholders. Our core principle of innovation, quality, and customer centricity remain integral to everything that we do. Now I move on to Q2 and H1 FY26 financials, starting with quarterly highlights. For the quarter, revenue from operations stood at 255.2 crores, representing a 5.4% year-on-year growth. The domestic market contributed to 115 crores, while the export accounted for 140 crores sales. Gross margin for the quarter stood at 39.5%, while the EBITDA came in at 26.2%, reflecting a 2.5% growth year-on-year. EBITDA margin stood at 10.3% compared to 10.6% in the same period last year. As I mentioned earlier, there was a hit of about 1% because of sudden fuel prices shock we saw in the last quarter. Profit after tax for the quarter was rupees 18.5 crores with PAT margin of 7.3%. Now moving to half-year highlights. Revenue from operation in H1 FY26 reached 574.7 crores, representing an 18.6% year-on-year growth. The domestic market contributed to 313 crores, while the exported accounted for 262 crores. Gross margin for the period stood at 35.9%, while EBITDA came in at rupees 60.6 crores, reflecting a 13.1% growth year-on-year. EBITDA margin stood at 10.5% compared to 11.1% in the same period last year. Profit after tax for the quarter was rupees 39.2 crores with a PAT margin of 6.8%. Capacity utilization level remains healthy across all the sites. Our Derabasi division capacity utilization was 77%, whereas Lalru division utilization was 62%, and Industrial Chemical division at Pune continued to operate at usual utilization level. With this, I conclude my opening remarks and open the floor to question and answer session. Thank you once again for your time and continued support.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Hello.
Hello.
Am I audible, sir?
Yes, we can hear you.
Yeah. Thanks for the opportunity, sir. So with regards to, my first question is with regards to the industry environment. So we understand for last 3-4 quarters in general, the commentary from our side and also the industry has been the export markets, the destocking is almost done and volume growth has been visible. But on the pricing front, there seems to be no change or the prices have become stable at the lower end. So just to understand, sir, on the pricing front, are you seeing any kind of changes in terms of the pricing part where probably some product prices have started moving up, some of them are still stable? Anything on that side?
I think so, Mr. Rahul. I think at the moment, overall pricing remains stable, except in some occasional cases where there are sudden supply shocks or something. But mostly the prices are stable. So for this year, we expect prices to be stable. And maybe because there are from time to time, we see a possibility to increase prices for certain products. So maybe in a couple of quarters, we will see improvement in the pricing and the margins for the industry as a whole and for our company also.
My second question is with regards to our bifurcation of sales between exports and domestic. So exports has done exceptionally well for us for last 2 quarters. In fact, the current quarter exports are almost at a 10-quarter high. And so what are the drivers for this growth which you are seeing in exports and how sustainable Or do we look at this number of 140, 150 crores? What kind of growth from here are we looking in exports?
I think what you are seeing a revival in export demand is commensurate with the commentary that we are having. The global inventories are at lower levels. Hence, the whatever product that we sell mainly to Europe, US and Japan markets, those demands is good, and hence our sales have increased. There is one more variable which I think from time to time that comes in, which we highlighted last quarter also, that in some cases customer takes the material in India. That's why it gets counted in as a domestic sale, where actually the material is for export. So overall, if you see from quarter to quarter, our export and domestic market share has been close to 50% each. Only it's mainly because of the accounting, or when the customer takes on the FOB basis, that gets accounted for domestic sales. But yes, overall, export demand is healthy, and all the products which is based on export, those plants are running full scale, and we are seeing very good demand this year.
So what kind of volume growth we have seen in this quarter, say year on year?
So year on year, we have already seen for export market about 10% growth if I put all the products together.
Mm-hmm. And what is the new product share in this, within this, in the first year, first half of the current year?
So overall, I think last year we had closed at about 12% contribution 12% revenue coming from new products. For the first half year, we are at about 16%, and this share is increasing slowly.
Sure. The last question. On the domestic front, this quarter is almost again at the lower end of last 5-6 quarters at 115 crores. So how much of it is due to kind of seasonality, some sales which happened in quarter 2, and are there any sales return in this quarter? And how do we look at the domestic sales going ahead?
Okay, so I think so broadly, domestic sales market demand has been quite stable. We saw one particular product where there was a seasonality, and that's where we saw a drop, which is not a long-term phenomena. It's a short-term phenomena of one or two quarters. So we see domestic demand being healthy. We are a B2B business. I mean, you just said about the sales return. We don't have sales return because we are into a technical market only, so we are not into formulation where there are sales return. It's only some seasonal demand, which sort of has gone down, and also this year this excessive rain has impacted some of the product local material movement. Otherwise, long-term trend is healthy and growing.
Thanks, sir. Thanks for the opportunity. Wish you all the best. I'll come back in the queue for some further questions.
Thank you. Thank you, Mr. Rahul.
Thank you. A reminder to all the participants, if you wish to ask a question, you may press star and 1 to join the question queue. Our next question comes from the line of Jainam Ghelani from Swan Investments. Please go ahead.
Hi, sir. Thank you for this opportunity. So, sir, as you mentioned in your opening remarks that you are evaluating a new site for further growth. So, sir, what is the quantum of this capex that we are planning, and when can we expect this? Because I believe that we've been looking over the last 4-5 quarters, we've been looking for new opportunities for a greenfield capex, but that is not capitalized. So, when can we expect one, please?
So, overall, I think we have been looking. Yes, I think you're right that we have been sort of looking for a site for last 4-5 quarters, and we have consciously not concluded this because we were sort of seeing signs. We were waiting for signs of revival for the industry demand, and we wanted to time it according to the demand revival. That's where you will see that we have announced a capex for new production blocks, because we believe that it will be rightly timed to the product commercialization that is happening for our product portfolio. And for this new site, we basically are already in discussion with a couple of potential candidates, and we hope to conclude this in next 2 quarters, this whole deal. And over a period of 3 years, the site capex will be about 350 crores.
Okay. And so, in the presentation, we mentioned that we've signed 3 new MOUs. So what could be the revenue potential from these three for the export-oriented products?
I think that we mentioned last quarter, each of these products is about 50 crores once the product fully matures and stabilizes. So we are expecting a sale of anywhere between 125 crores to 150 crores over a period. I think it will take, because you know the cycle which is there for agrochemical products, which starts with sample approval to 5-batch analysis to the product registration. So there is a slightly longer gestation period, but once that happens, steady state sales will be anywhere between 125 crores to 150 crores from these three MOUs.
Okay. And so last question from my side. So do we maintain the guidance that we had given in the last con call, that 1,200 to 1,400 crores revenue in FY27 and 16 to 18% margins?
So I think what we had given for FY27, yes, around 1,200 crores so what we have given in guidance was about 15 to 20% year-on-year growth. That's the first guidance we had given, that we maintain. And second growth, we had maintained that eventually over a period of time, we are targeting an EBITDA margin of 16 to 18%. I think we didn't mention specific to FY27, but in long run, over a period of time, we are looking at increasing our EBITDA margin to 16 to 18%.
Also, just to add, as Vinod said, that some of these products have their own registration and which takes time. We are in close contact with our customers, and we believe that once this come in, it will be a robust way forward in terms of revenue.
Okay, sir. Thank you. That's it from my side.
Thank you. A reminder to all the participants of the conference that you may press star and 1 to join the question queue. Our next question comes from the line of Rudraksh Raheja from iThought Financial Consulting. Please go ahead.
Yeah, thanks for the opportunity, sir. Can you give us an outlook on EBITDA margins for this year? Like 16 to 18% you said for the long term, we should expect. How should we end this year?
So I think for this year, we will maintain steady EBITDA margins of around 12%. So it should be anywhere between 11.5 to 12.5% is what we will look at this year. And then gradually improving from next year onwards.
And so could you throw more light on the levers we have for margin expansion? The bridge that is there from, let's say, from 13% to 16%, the incremental 3-4%. What are the levers we have that will kick in and help us attain that level?
So there are 2-3 levers that we are focusing upon. One is obviously the new product introduction, which we believe will give us higher EBITDA margins, and the share of these products gradually will improve. That will be the biggest contributor to improvement in our EBITDA margins. Second lever is our aggressive effort on making sure that either we improve our efficiency of processes, or we are also looking at some backward integration so that we can improve our competitiveness and margins. And lastly, obviously, this is more dependent on the market. We are finally believing that maybe the worst period for the market is slowly getting over, and over the next 1 or 2 years, market will go back to normal conditions. Hence, our ability to charge better prices, or our normal prices, I'd say, for most of the products will be much better. So I think with these 3 components, we believe that we should be able to reach that EBITDA margins of targeted EBITDA margins.
Got it. And sir, when you say that we are looking a bit on the backward integration side also, would that come in with our new greenfield capex, or it would be separate from that?
So it will be, basically what we are trying to do is to map various assets. So it's not very specific to whether it will be a part of a new greenfield or the brownfield expansion. It is more around looking strategically to certain key raw material and seeing whether we can make it in-house or we can develop a process where our cost is lower than what we procure from the market.
Understood, sir. And so you touched upon the industry trends with respect to prices coming back and all of that. How is the performance of our legacy molecules like metametron or metconazole in the first half of FY26, both on pricing and volumes front?
So I think I will not comment product specific. Overall, I'll say that demand is healthy and our volumes are steady. In fact, maybe higher than what we have done in last 2 years. On the pricing front, we have not seen much improvement in the pricing this year, but volumes are much better. So that's where you will see a momentum picking up there. And as the market sort of demand stabilizes and the capacities get full, we believe that over the next 2 years, our traditional molecule like metconazole or metametron or ethofimizate, our profitability will improve because we have worked very aggressively on these products to also improve our cost. So once the market improves, our profitability will be quite healthy.
Got it. Thank you so much.
Thank you.
Thank you. A quick reminder to the participants of the conference that you may press star and 1 to join the question queue. Our next question comes from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, harping back on the point of decline in revenues in the domestic markets. So this has been our, like over the past 6 years, past 6 quarters, this has been our lowest revenue in domestic market. And, we have seen performance and commentary of some of the formulation players for this quarter, for Q2, where they have highlighted challenges in the market because of lower pest infestation and unseasonal rains. So if you can comment on that, and how do you see the domestic market playing out for the second half of this year, given, we have seen some unseasonal rains in October month also in some of the geographies?
So I think overall in the domestic market, what you hear from the market is right, that there has been, because of unseasonal rains all across India, there has been an impact on the demand for this particular season. And that's where you have seen some impact, but we have been able to significantly make up for that from our export sales. Now, we expect the domestic demand to pick up, maybe not to the same level, not fully, but we are quite confident that we'll make up for any shortfall in the domestic sales with an export sale. So that's the overall product portfolio. That's how it is now shaping us for us.
But do you see this challenging scenario continuing in second half also, given the rains we have seen in October?
Some spillover impact will definitely be there, because finally if a season is not good, some impact will be there, and that's where we believe our export demand, which is looking quite healthy, will mostly compensate for it, and maybe even we will still be able to maintain our original projection of about 15 to 20% growth in this year.
Some of the formulation players have highlighted that October has seen a significant decline in the market, and Rabi also has started on a very weak note. So have you also observed that?
Yeah, I think we are in the same industry. So finally we'll see the same impact. But again, I repeat that overall our product mix right now is looking such that we have increased export sales, and overall demand, if there is any shortfall from domestic, we'll cope up for or make up for that, more than make up for that from our export sales.
Sure. The second question on the margins front. So, given higher proportion of export sales in the quarter, and despite that, we haven't seen much improvement in our EBITDA margins. So, have the margins in the domestic and export market largely in line with each other, or how does it work?
I think I will not like to qualify based on the market. Overall, what I will I'll make 2-3 points. One, obviously, we saw a hit of about 1 to 1.2% in the last quarter on account of unseasonal rains and fuel And I mean, obviously, along with fuel, because of the rains, there were a lot of power outages, which also resulted into a lot of inefficiencies in operation. So that's one factor. And second factor is mostly our traditional products margins have started improving. They have not reached the healthy levels, but new product margins are healthy. I think that's a broad comment I would like to make on this particular point.
Thank you, Mr. All.
Thank you.
Thank you. A request to the participants that while asking a question, please keep your lines on self-mute to ensure that there is no disturbance while the management is answering your question. And another reminder to the participants to press star and 1 to join the question queue. Our next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, I'm audible, sir.
Yes, we can hear you.
Yeah, thank you very much for this opportunity. So just first up, wanted to understand our tax rate. I mean, this quarter our tax rate was very low. So how should one look at tax rate going forward?
Our tax rate is, we have opted the lower rate, that is 22%. But during this quarter, we had received the one order which is in favor of the company from ITAT. And the excess provision of around 2 crores was written back in the reserve.
So on an annual basis, we should look at 22%, right?
Yes, that's right. 22 is the base rate, but including the surcharge and all these things, the exact rate is, effective rate is 25.168%.
Okay, understood. And what about the other income? I think last 2 quarters we are seeing some other income. So can you throw some light on the nature of it and how sustainable are those other income?
I think other income mainly is on account of foreign exchange gains. That is basically mark to market. So that keeps on happening from quarter to quarter. As you have seen, rupee has depreciated in the last 6 months. Euro has appreciated significantly. And that's where we have seen those other income, mainly on account of foreign exchange.
Okay. So our 40% plus exports, right now. So which country would dominate that? From which countries would be getting majority of our exports?
So mainly our exports are Europe, Japan, and US. I think these are the 3 geographies. Majority is contributed by Europe, but that does not mean that all the transactions are in Europe. Even if you sell it to Europe, transaction can be in dollar or euro, depending on the customer and our agreements with the customers.
Understood. And any impact on the tariff?
We have had some impact, but negligible so far, mainly because the customer in US have still continued to buy the material because it looks like the cost of any tariff will be borne by US customer. But long-term impact is yet to become very clear. At the moment, we have not seen any significant impact on our business.
Understood. And any capex figure we have for this year and next year, FY26, what sort of capex we are planning?
I think we have already announced. So basically, year on year, we do about 20 to 25 CR on asset renewal. That's what that number remains for this year and next year. And for the new blocks, we have already announced that we will invest about 60 crores in the new production blocks. And then new site, as and when it comes, in phased manner, there will be a capital outlay for that project.
Okay. No, so I was just trying to understand the capex plan for this year specific and next year separately. Is that
this year? I think we will end it for asset renewal about 25 CR for the existing asset renewal. Some capex for some capacity expansion. So total capex may be about 35 to 40 CR for capacity expansion and for asset renewal. And maybe this year another 10 to 15 crores for the new blocks that construction that we have started. Because majority of capital outflow for the new blocks will happen in Q1, Q2 of next year.
Okay. So only 10-15 crores in the new site we expect to
yes,
spend
right.
this year. Okay. I got it. And just one last thing. when you mentioned EBITDA margin of 11.5 to 12.5% for this year, this is excluding the other income, right? I mean, operationally, you're talking about that.
I mean, that's what is we are. So all the numbers what we are talking about is excluding other incomes.
Okay. No, so the reason I'm asking, I mean, first half, your margin average is around 10.5%. So second half, you have to do 12.5, 13% to have that average of 11.5%, right?
Yeah, I think our product pipeline and etc. looks such that we will be able to improve because the product mix, I think most of these things are dependent on product mix, and our second half product mix is better than first half.
Fair enough. Okay.
And also we don't expect unnecessary, unexpected costs like flood and all, where we incurred a lot of expenditure in the first time.
Understood. That's very helpful, sir. I mean, that would be.
Thank you. Thank you so
much. All the way best. Yeah.
Thank you. A reminder to the participants that to ask a question, you may press star and 1 to join the question queue. Our next question comes from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Thanks for the opportunity, and good to see the exports performance is improving. So just one question again on the exports market. So given that we have seen a quite strong growth on a YOY basis, is it that the Chinese supplies have been moderating, and that's the precise reason generally it is being beneficial for the Indian counterparts? So what is your observation, and based on your talks with your customers and the pipeline, do we see that in the next half also the same export momentum will continue? Thank you.
So I think overall what market demand for most of our products has remained healthy in this year, and our efforts to improve our efficiency cost over the last 2-3 years has helped us to stay competitive in the market. And despite the Chinese supplies being available in abundance, we have been able to maintain and grow our market share. And that's where you will see our export performances slightly better. So to answer your first question, Chinese supplies have not subdued or anything of that sort. It's mainly around market competitiveness, our ability to play in that market. I think that was your first question. Second question, whether we will be able to maintain that momentum. I think as I mentioned, rather than mentioning specific domestic or export market, we will continue to maintain our overall guidance of 15 to 20% revenue growth year on year for this year.
Perfect, sir. That's helpful. Thanks a lot and all the best.
Thank you.
Thank you. Our next question comes from the line of Anupam Agarwal from Lucky Investment. Please go ahead.
Thank you so much for taking my question. Sir, my first question is on your comment made in the last Concall. You said 5 products will commercialize in FY26. Can you give some light on how many have been commercialized in the first half, and what has been the feedback and traction on the ground?
Okay, so from on the 5 products, 2 products we commercialized in the first half. And both products have been accepted very well in the market. And now we have started working on next year demand because these are all seasonal products. So this year we started on a very strong note with a very good acceptance for these products. Other 3 products, we have now taken up commercial trials for those products. I think those are also on track in terms of our plan to start commercial supplies in second half.
Okay, so will all 5 be commercialized by FY26?
We will commercialize all 5 in FY26. That is right. For each of these, obviously, say for example, one product that we commercialized in the very first year, we were able to do a very healthy volume of about 35 to 40 tons. Whereas for other products, the volumes is depending on the market and customers' requirement for commercial trials and market, I'd say market acceptance test. So all the 5 products will get commercialized. That's for sure.
And what is the breakup in terms of the end application?
These are all basically 2 products are in agro sector One is a pharma intermediate and 2 are in specialty chemical sector.
Understood. And all these 5 products are for export market or any for domestic market?
I think out of the 5, 3 are for domestic and 2 are for export market.
Understood. My next question is just comparing the H1 over H1. Our gross margins have fallen by about 250 basis points. Can you give some drivers as to why this has happened?
I think, as we mentioned in Q1, what we had done this year that in order to align market demand with capacity utilization, we had done a lot of production in last Q4 of last year. And per accounting practice, once you produce, most of the costs gets absorbed there. So the gross margin for Q1 were on lower side. Because that was more of a strategic call that we have taken so that we can capture the market in Q1. And that's how you see the gross margins are on lower side. But at an overall business level, the margins are around 39 to 41%. That's what we have been maintaining and that's what continues to be the case.
Understood. Understood. My third question on your capex. So I understood your capex plan for the next 2-3 years. How are we planning to fund this?
So it will be partly from internal accruals and rest from we'll take that depending on the timeline and the requirement of the project. That's the main idea right now. I think Shalil, if you want to add anything, that's the immediate thought.
So as far as the capex part, we are also looking at various other aspects in terms of on raising these funds. So at the moment, as Vinod said, yes, it will be through internal accrual and partly debt. And as and when we come up with a right solution, which we are already on it, we'll definitely let you know.
Understood. Just one more, if I may. I remember your comment made earlier that existing gross block can give about 350 crores of revenue per quarter. Any changes in that given the market dynamics, or would that change?
No, so at the moment we maintain the same thing. I mean, as I said, all these products go through, whether it's a pharma intermediate or an agro, it goes through various parts of registration. And as Vinod did mention that all our products out of the 2 which are commercialized and the remaining 3 will be commercialized. So we maintain the same momentum at the moment.
Understood. That's it from my side, and I wish you all the best. Speak to you next quarter. Thank you.
Thank you.
Thank you.
Thank you. Our next follow-up question comes from the line of Rahul Jain from Credence Wealth. Please go ahead.
Yeah, opportunity again. Hello?
Yeah, go ahead.
Hello, Mr. Rahul, can you please go ahead?
So, one question with regards to the phosphoric acid. So, the existing unit, I understand, can give us about 160-180 crores of sales. And then we were planning some expansion in the phosphoric acid also. So, that will be a part of the new greenfield project only, or are we trying to put up a separate unit for that?
No, so as we mentioned, and you're right, that the existing business can give a revenue, which we are right now at between 120 to 130 CR, and an additional 50 to 70 CR can come in from the existing site. The new site, as you know, that we are in discussion with our customers, and it will be coming up in the new site. And as Vinod mentioned, in the next 2 quarters, we are almost in discussions, and once it is finalized, we'll let everybody know at the appropriate time.
Oh, so this will be a part of the larger greenfield capex which you are talking about?
Absolutely right.
Sure. So with regards to gross margin, so we are currently in this quarter around 39.5% gross margins. With proportion of new products rising, and with this new 3 contracts which we have signed, out of which we have some specialty chemicals also. So, in terms of gross margin, where do we see our gross margins going ahead in next 1 to 2 years?
So as the new products come in, and as we mentioned that these new products have a better capability in terms of the margins, because there are not many players, and these are more long-term contracts with good multinational companies with whom we are dealing with. So in the next 1 to 3 years, at the moment, if we are at 38-39%, we expect to go anywhere between 40 to 45% in the next 2 years.
Sure. And with regards to this brownfield block, it is expected to commission or commercialize by what time frame?
So we are targeting Q3 of the next year. I think we're targeting it to be commercially available in Q3 of next year.
Sure. Thank you. Thanks for the thank you.
Thank you.
Thank you. Our next question comes from the line of Richa Joshi from Om Associates. Please go ahead.
Hello, sir. So my question is, how are the demand and pricing trends in key export markets like Europe, Japan, and Latin America evolving compared to like Q1?
So I think Mr. Cha has mentioned earlier, pricing scenario has not changed significantly over the last quarter. So they continue to remain stable at lower level for all the markets. And however, demand is healthy. So the good part is that demand has revived, and we expect that with the demand revival, over the next couple of quarters, we will also see pricing revival. That's one for our existing regular products. And for new products, obviously, pricing and profitability is better than our current set of products.
Okay. And also, sir, like given the increased exports, like how are you managing the credit terms with customers?
So we have very well-defined credit policy and credit terms with most of our customers. And a lot of these sales are backed by LC or some discounting. So those are the payment terms which are from customer to customer, varies from customer to customer. And it's quite healthy. So our payment terms with most of our customers is very healthy.
Okay. Also, my last question would be like with increasing CDMO exposure, what share of total revenue now comes from CDMO versus your own product?
Okay. So from CDMO, we are at about 55%.
Okay.
50, close to 55 to 60% is CDMO, and balance is our own products.
Okay, sir. Okay. Thank you.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all the participants of this conference that if you wish to ask a question, you may press star and 1. Our next question comes from the line of Anupam Agarwal from Lucky Investment. Please go ahead.
Yeah, thank you for the follow-up. So just extending to last participant question, what was this CDMO mix, let's say, 3 years back? How has that portion of the portfolio grown?
Over a period of time, I think we have grown, I don't have the exact number, but maybe from about 45 to 48% to 55 to 60%.
And any color that you can give us in terms of the difference in gross margin between own products and CDMO products?
I think we will not like to, we generally don't give that kind of a breakup. So it will be difficult for us to give that kind of a breakup.
Only thing I'll just add that, these certain things are confidential, but definitely the margins from new product will be much better than the existing one.
Fair enough. Thank you so much. Thank you so much.
Thank you. Our next question comes from the line of Rohit from iThought Portfolio Management Services. Please go ahead.
Yeah, good afternoon, sir. So just one question, clarification on your gross margin comment. So you mentioned that the first quarter, I think you had alluded to in the last call also the reason. So do you see as the inventory that you would have stocked up as it gets sold in the next couple of quarters, like how the gross margins have normalized to your historical levels, they'll normalize to those levels in the coming quarters as well, and at an overall level, it will be like a normalized gross margin. Is that how we should look at it?
So I think, yeah, you are right. If you see our, if you look at our net working capital movement in the quarter to quarter, we are back to a normal cycle of about 60 days. So whatever inventory that we built in Q4 of last year, we have been able to sell and liquidate, because that was a strategic call that the demand will come in Q1, Q2, and we will be able to liquidate that inventory. So on a consistent basis, if you look at overall yearly basis, our gross margins will remain in the range of 38.5 to 40.5, 41%.
Right. Got it. And in terms of the new products, so the 5 new products that you mentioned, so in FY27, all of them will get commercialized? Sorry, I missed that actually. So if you can.
I think the question was that we had basically made a prediction, or rather prediction. We had planned to commercialize 5 products in this financial year. Are we on track with this or not? Right. So we are on track with this. I think that was the first question, response to your question. And all these products will see another campaign in the next year. And as the market acceptance, formulations, etc. grow based on our products, slowly and gradually the demand will keep on growing year on year.
And for these new products, we will have enough capacity in the existing 2 plants that we have, and they will be enough. I mean, you'll have to do some debottlenecking. I think you mentioned some brownfield investment you had mentioned. So these will cater to them, right? You don't have to do.
So these, I think, we are So we are doing it in 2 parts. One, whatever demand we are forecasting for now and next year will be taken care of by debottlenecking and product rationalization in existing facility. And till the time the product demand reaches a level where it can actually require a dedicated plant, our new blocks will be ready. So that's how we are planning these.
Okay, good. Thank you, sir. All the very best. Thank you.
Thank you. Anyone who wishes to ask a question to the management may press star and 1 to join the question queue. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
So I would thank everyone for your precious time, and I hope me, Vinod, and Bishan have satisfactorily replied to all your queries. Sometimes please understand that few things like margins, etc., product names are confidential, so we cannot share. And we once again thank you for your support and your interest in our company, and all the very best, and talk to you again back during the next Concall. Thank you so much, and have a wonderful day.
Thank you. On behalf of Antique Stock Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.